There's some terminology to keep in mind when we're talking about the stock market. First of all, valuation. This refers to determining the value for a financial or real asset, but financial assets in the stock market, based on the present value of all the future expected cash inflows. The valuation is a calculation based on expectations. The intrinsic value is the theoretical value of the stock based on those future expected cash flows. It's the investor's perception of the value of the stock. There are two basic ways to earn a cash return with a common stock investment. The first is that the firm could declare and pay dividends. This is a direct cash payment from the company to the investor. The other way is that the market price of the stock could change. This could create an increase, called a capital gain, or a decrease, called a capital loss. So this could either augment or offset the cash dividends paid by the firm. A firm's stock also has what we call a market value. This price is determined through the interaction of supply and demand in the market. When market participants refer to a market price, they're usually referring to the last transacted price for the asset that was determined by the highest bidder for the stock. The supply of common stock shares comes from the issuing corporations and from other market participants selling shares that they already own. The demand for shares comes from investors who desire to buy stock. The interaction of supply and demand frequently results in transactions, where the price the buyer bids is the same as the price that the seller asks. That transaction price is called an equilibrium price, since the quantity supplied equals the quantity demanded at that price. It's popular to think that the market price is the price that the market thinks the stock is worth. That's not quite the case. The market price is only determined by one buyer. This is called the marginal investor. The one person in the entire market that bid the most for the stock actually determines that stock price. So when you hear the term market price, it's really referred to the last transacted price, the one the highest bidder paid a few moments before. So who purchases this stock? Well, it's purchased by individual investors like you and I, groups of investors, and institutional investors, such as banks, insurance companies, mutual funds. These institutional investors often invest on behalf of individual investors who buy shares in the institutional investing company, and then those funds are used to purchase stock. All of these investors provide funds for use by corporations, and in exchange they receive a share of the ownership of the firms. So what determines a firm's stock price? Well, managerial actions influence shareholder expectations. The actions of the firm's managers produce some level of financial performance, and performance affects the investor perception of firm performance in the future. Figure 1.3 in the notes shows the actions that managers take and the way those actions affect shareholder expectations. Managerial actions include long-term decisions that affect the future earnings capability of the company, short-term decisions and policies affecting the current earnings, and managers also provide information about the condition of the firm. All these things influence the shareholders' expectations about dividend yield, cash flow expectations, capital gains and losses or growth, and also the perception of risk associated with owning the stock. The intent or purpose of financial management as a discipline is to make decisions that produce the largest increase in the firm's value. This is called an optimization objective. In a nutshell, the objective of the financial manager is to make decisions that are in the best interest of common shareholders and to inform financial markets about their success in making good decisions.